Is the Santa Claus rally canceled this year? It certainly seems like it could be, with Nvidia, the one stock to rule them all, threatening a major weekly breakdown. And as we covered on Wednesday, the market breadth is absolutely horrific. Not to mention that we have interest rates attempting to break out again, and the Fed announcement is this week. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we've got a red-bodied bar. It's pretty small in terms of overall range that was traveled. There's a slightly longer lower wick than there is upper wick, but it's really not meaningful in terms of the story of what this candle is telling us. I would argue that the sellers have a small upper hand here in terms of structure, of course, the red-bodied bar meaning that the close is underneath the opening print. In terms of candle location on the bar-to-bar count, notice that we have a lower high and, for all intents and purposes, an equal low. So almost an inside bar here. It's a consolidation of range. So if we're not really getting big indications on the bar-to-bar count, then it's time to zoom out a little bit and just say, okay, what's the overall trend here? It's still absolutely up with lows, higher lows, and recall that we've been calling this a soft higher low because during this red weekly bar right here, we actually did not see a daily downtrend. So for that reason, I'd be incredibly bullish on the S&P 500 so long as the weekly time frame chart is over 600. This is bullish consolidation over the previous pivot top, and I'll be looking for continuation in the upward direction. Now, if we fall under 600, I'm still very interested in this level right here, which we've been tracking as 585. If we're under 600, there's absolutely the opportunity intraday, intra-week to trade some shorts, but I do believe that a weekly higher low could be found at that level still. If we come in here with a couple of Fibonacci perspectives from the August 5th gap down low up to the most recent all-time high, we're well above the 38.2. Even if we get that deeper pullback to 585, we're well above the Fibonacci 38.2. If we come in with a fib from the low prior to the election to the most recent all-time high, notice that the 61.8 is right at that level. And from a Fibonacci analysis perspective, that's always going to act as the line in the sand. It would be even better if we stayed over 600, of course, which would still be above the Fibonacci 38.2, which is kind of hidden in that green candlestick there. Let's quickly check in on the anchored view apps from a weekly perspective. I've updated some of these anchor points. We're above the entire spread, but what do we see here? The election gap up anchored view app is showing us that that will be the top of the stack and confluence at 600. So on the weekly chart, as long as we're over 600, it's absolutely bulls on parade. As we start to look at this anchor point from back here, that technically marks the breakout of the weekly time frame chart from the low. The higher low, we had highs, equal highs, and we finally broke out, right? We came in for the retest over here. That's the election bar. So that next most important anchored view app is suggesting to me that it's confluence with that 585 level. So everything that we've talked about here in terms of trend still makes sense, and we are getting additional indications that support this thesis. Once again, the most bullish consolidation over 600, looking for continuation. If we pull back under 600, it's okay. We can go to roughly 585, and that would be the next major weekly level where I would need to see buyers step up to maintain the overall uptrend here. If we were to break 585, then absolutely we have higher time frame issues. We're just not there yet. Let me clean this up here, and we will go on over to the volume profile on the weekly time frame chart just to make sure that this aligns with what we've talked about so far. Where is this high volume node? Lo and behold, it is that weekly breakout point. So I would say that that's a key area, but we know that we really want to focus on this right here. Where is that? 585. It's the next major high volume node over the weekly breakout point. So still all set from that perspective. And even if I take a look at this high volume node here, doing something along those lines, it's very close to 600. It's very close to the lows of last week. And I can even do this as well, so it becomes a little bit easier on the eyes. We're not looking way off to the left trying to find these things. Here's the high volume node, right? As long as we're over that, we're good to go. As long as we are over this high volume node, we are good to go as well. So all set on the weekly time frame chart. I would really start to change my tone on the higher time frames when and if 585 starts to fail. But as of right now, we're just not seeing those indications. Let's take a look now down on the daily time frame chart, and we'll firstly evaluate this week's expected move. If you're not familiar with the expected move, of course it is the gray shaded box with the blue or cyan top and bottom right here. If you're not familiar with the study, check out the video tutorial in the top right hand corner. If we're contained by the upper bound, the number is at 612.03, and that of course would imply a brand new all-time high and a higher high in the trend count. That's of course bullish. If we're contained by the lower bound, the number's at 596.41, which unfortunately is not really suggestive of a higher low. Because we did establish an hourly downtrend here, this is the last higher low in the daily sequence, so the lower bound of the weekly expected move would unfortunately suggest a daily lower low in the trend count. You could see how we sort of have an equal low headed into the Friday session. Breaking down is slightly more bearish here. So is it the end of the world? No, because on the weekly time frame chart, it's not really threatening that key inflection point 585 that we were just describing over here, right? The daily trend is still up at this current moment in time, and we're starting to fall a little bit more so into a daily balance based on this consolidation range happening over here. I'd still be a proponent for a loose higher low. I know I just mentioned how this was the higher low, but I'd still keep a bullish stance on the trend count as long as we're over $600.50, which aligns with the weekly level that we were just talking about. As long as we're over what was once acting as resistance, once acting as resistance again, as long as we're using that as support and we're building this consolidation over that zone, I would not change my tone to being aggressively bearish, even if we take out the low of the Tuesday bar from last week. I think $600.50 is still too important of a level to really, flip-flop over to the bear side just yet. Now, it doesn't go without saying, of course, that we do start to see up here the failure on Wednesday for the buyers to really accelerate prices back in the upward direction. And I do have a small issue with this on Friday with the open well disjointed from the Thursday close. We'll get more granular there on the hourly chart in just a moment, but I do want to bring out a daily Fibonacci from the pullback low up to the most recent high to just reinforce that the Fibonacci 38.2 is very close to the $600.50 mark. Once again, reinforcing that as a key level. While we're on the daily, if we were to break down underneath that, the lower bound of the weekly expected move could act as a target, which is confluent with this back here. Recall that it was a perfect gap fill reversal at 595.25. Anything beyond that is the top end of this 4-day balance range at 590.25, at which point we're likely in a daily downtrend. If we do continue in the upward direction, let's just say that consolidation persists here, because let's call it for what it is at this point in time, right? This, until proven otherwise, is simply a bull flag, right? If we continue in the upward direction, it's of course blue sky territories. That's over 609 as your all-time high breakout. Let's drop it on down to the hourly time frame chart though, so I can tell you about my little issue here, my little hang up with Friday's open. Friday's open was quite a ways away from Thursday's close, and it was also an attempt to get green over a red bar. You could see in the open there was a small bit of price action on Friday morning over 607. And if you just compare what happened on Tuesday of that week to Wednesday, right, where we had that move in the upward direction, something similar had the opportunity to take place, right? You have sellers really piling into this underneath the lows on the end of day breakdown from Thursday. It was really a balance range prior to that, but sellers located pretty poorly into Thursday's close who were offsides on Friday's open. My expectation was that, okay, we should likely see a rotation into the top end of the range, and that of course did not take place. So the evaluation here on the hourly time frame chart is certainly that the hourly trend is neutral. There's no trend in this box. We're really just going more so sideways. And there's the potential for lower here if prices can accept underneath 604.25, the low of Thursday's session. Now, what do we notice about Friday afternoon? We certainly started to get a Brigade bolt, a bearish one, underneath that level. There's certainly the opportunity for a lower high underneath 604.25. And if that's the case, I think it's a pretty easy argument to make the rotation, if you will, into $600.50, the key daily level that we were just talking about. So early on this week, it really is going to hinge upon 604.25. Where do we open on Monday? If on Monday we open over 604.25, we need to see a higher low above to potentially revisit the midpoint of this range, and 607 is really the key inflection point. If we can Brigade bolt over that, there are long trades into the top of the range. Now, of course, I'm using the white crayon here because ultimately we're just inside of the balance range. The market's not really trending on the hourly time frame chart. If things were starting to look more bullish, of course, we would want to see a breakout over the top of the balance range. So first steps might be an open on Monday here, hold of 604.25, Brigade bolt there, and then of course to blue sky territories, that's likely where we should actually bring out the green crayon. So here we have the hold, here's the higher low above, top of the range, let's flip to a green crayon, there we go. That of course is where it's bulls on parade. So from a risk reward perspective, is it reasonable to try to grab longs down here if your reward is ultimately up towards the top of the range and then ballooning runners into blue sky territories? Absolutely. If you believe the market's going to continue in the upward direction, risk reward here absolutely favors the longs. But if we're underneath 604.25, let's just say that on Monday we open up down here, the first threat should be okay. A lower high that persists underneath probably looks left, and we should have another gray dotted line in here right around, let's go 602.50 for the sake of round numbers. You guys know rule number 2 up here in the penthouse. Let's go 602.50 with a dotted line here. If we break below that, your rotation is clean into $600.50. Now, for the bears, is this an opportunity to short? Probably. There's probably some sort of short that unfolds from this perspective right here where you can have risk and then, of course, reward down into that $600.50 mark. But thinking and putting my daily bullish hat on here, I would certainly be more of a proponent for saying, okay, is there an opportunity now for some sort of reversal actually off of $600.50 to hold this as a daily higher low? Right? Daily higher lows, as we just mentioned, can persist over that level. Now, again, we'll talk more about the thesis as to which of these is most likely as we get into Nvidia and the potential threat there based on the very weak breadth in the market. But anything that does not hold $600.50 probably gets that rotation, as we talked about, into 595.25. And I do think that this is a reasonable thing to at least have on your radar for this upcoming week's session. 595.25 should not be like, oh, no, it's too far to the downside. Nope, it's definitely there as a reasonable threat. Let's quickly throw on the intraday anchored VWAPs, then we'll start to get into some of the supporting evidence that tells us yes, no, maybe so. In terms of what's above us, notice the all-time high anchored VWAP as well as the final, or I should say the last major breakout anchored VWAP. It is going to act as resistance confluence at 604.25. Once again, if we are underneath that, let's say that these barrel down early on in the week. If we're underneath, that should act as resistance at minimum, achieving $600.50. And then if we can get the recapture, let's say this is a double bottom or whatever, this is where I would then trade back bullish in the upward direction there, higher low that recaptures. If we move to the downside, let's say that over time, and these are going to be very slow, it'd probably be like midweek, if not end of week, by the time these catch up. If we were to get some consolidation that persists all week and then we meet here, decent opportunity for that higher low we were just mentioning. If they're just down here, I would not be afraid of the potential breakdown that changes the market's tone on some sort of move like this. Yes, they're important, but they're supporting evidence. We all know that price levels rule all here. So that's the analysis. The levels are quite clear. Let's jump into some of the supporting evidence that suggests whether or not this is likely to happen, the breakdown or the hold. If we're taking a look at the market internals, if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. The internals looked absolutely, I should be careful with the word horrific, but they did not support upside last week. That is for darn sure, right? And this ties directly into breadth. Remember that everything you're seeing on the screen here is a measure of what's happening at the exchange level, the full NYSE exchange. So breadth was certainly out of the market here on a majority of sessions. You can see net flows on the week were negative 450 million. Not substantial. Substantial is negative 500 million or greater. Could be net positive, of course, if we're talking about inflows. The advanced decline line spent a majority of the week in the lower territory, underneath zero, as you can see here. Trending lower on Monday, negative on Tuesday, Wednesday slightly above, trending lower, right? If you're looking at the actual index score, there was one decent day that supported the Wednesday CPI rally here, but that was it. Thursday, as we got that midday consolidation, the index score was actually negative in here. So once again, supporting more of this bearish thesis. Oh my goodness, suddenly this seasonality call where everybody's saying, oh, the Santa Claus rally's got to drive us higher into the end of the year. If Nvidia starts to slip up a little bit more than it already has, I think that the seasonality call might be something that comes to pass here and not play out. So if we look at the Thursday cumulative build, horrific. If we look at Friday, horrific as well. Maybe not horrific here at the negative 3,000 mark, but you get the idea. The breadth across the market exchange, the NYSE exchange, is not supporting that new money buyers are stepping into this. To me, this is really starting to suggest more so profit taking, because on the same flip side of that coin, notice that we didn't have substantial volume outflows that are typically classified as like panic, sell everything, oh my goodness, it's got to be a big new money short, right? We never breached negative 300 million. The index score was not persistently at like negative 20, negative 25 throughout the week, and we only really had one day get close to that negative 5,000 mark here. So to me, it's profit taking. It's people not willing to put new money longs into the market here with things sort of running on fumes, right? That's one of the ways that you might describe the market here, running on fumes based on a couple of the Magnificent Seven names. And the one stock to rule them all, Nvidia, starting to look weak, which is going to have some drag on the market. So here's the market profile. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. And what I want to illustrate here is the threat early in the week that we have overhead supply. If you look at where value was on Monday, I'm going to go all the way across with all of them. Here's Monday. Here is Tuesday. Here is the Wednesday session. Here's Thursday, and where, of course, did Friday spend a majority of its time? Where was the point of control on Friday? Obviously, in A period, B period, and even C period during the breakdown earlier on in the session, it was a rejection of the value that is now existing above us. We have overhead supply. So the more time that we spend underneath this overhead supply, the more likely it is, in my opinion, that profit taking continues. We would really need to see a rotation back into this range to see unchanged value here if the market's going to persist as being bullish and threaten the bull flag breakout on the daily time frame. Another nuance in market profile that we should pick up on is just the fact that we have this poor low on the Friday session. We do not have the proper end of the auction. So what does that mean? If the auction needs to end properly, we should auction through it to the downside and then make an assessment. Do we stay below after we've repaired this level, or do we not? And based on the overhead supply, it would seem reasonable to me that if we do break down underneath what's almost a perfect double bottom, not quite, pretty close. If we're underneath that, again, I think the bear argument starts to become a little bit more reasonable. So that's what we've got to the downside. I also don't want us to forget about the all-time high. Let's see if is Trade-of-Eight going to cooperate. There we go. The all-time high, poor high as well. All right, so that does still exist up here. The all-time high is not a secure high, right? So just like this needs some repair, so does this up here. But in the current circumstances of the market, certainly seems like the overhead supply is weighing more so in the downward direction. So that is what I've got for you on the S&P 500 analysis in the immediate term. As long as we're underneath 604.25, I do believe that the bears have an edge. I would be looking for longs off of $600.50 for risk reward back in the upward direction. But one of the more responsible ways to play that perhaps is let this come into $600.50 and then play the higher low back in range. What would this suggest? Just as sort of like a final comment, not to be overly bearish. What is this right here? Hopefully what you're saying is a look below and fail, right? If this is a balance range happening here, you test under the balance range and then find a higher low back in range, sellers ultimately failed, right? Sellers failed here, and then we would look for long rotations back to the all-time high and repair of the all-time high, poor high that we just saw in the market profile. So generally speaking, that's where my head's at. If the sellers fail, I'll flip back to being a little bit more bullish, but the market does seem to be a little bit tired here, and we'll see this in some supporting indications as well through the sectors and some other nuances that we typically check in on. But for now, let's move it on over to the QQQ NASDAQ 100 and see what's going on from this perspective. We need the weekly time frame chart to kick things off here on the good old NASDAQ, and there is going to be a small divergence here, right? Of course, the NASDAQ had an incredible amount of strength on the CPI report, really going on to produce brand new record highs. So in terms of keeping with the theme of the show, or the methodology of the show, we should take a look at candle structure and location on the weekly first. We've got a green-bodied bar. First and foremost, that's different than the S&P 500. Secondly, it's much more hammer-esque in nature, meaning that we have a longer lower wick than the size of the body, than the size of the upper wick, which means at one point, sellers did have the upper hand, causing a pullback, but buyers were clearly able to rally back up to the opening print, through the opening print for range expansion, and a decent close, a brand new all-time high close on the weekly time frame. So Are we bearish on the QQQ NASDAQ? The answer is no. Even at the weekly scale, you could start to see how, okay, S&P is probably a little bit slower. It's not bearish on the S&P weekly, but it's probably slower, and the NASDAQ is really where the strength is in this current market environment. If we consider the actual location of this bar, obviously on the bar-to-bar count, a higher low as well as a higher high. And most notably, look at this lower wick and how it aligns with this previous pivot top back here, a beautiful higher low sequence that we'll see on the daily time frame chart in just a moment. So no issues out of the QQQ weekly for the sake of being congruent. We'll come in from the August 5th lows up to the new all-time high. 38.2 is well above the double bottom neckline. Remember, that's this pattern from back here. If we come in from the low of the election bar up to the all-time high, 38.2, right on the money off of the daily pivot, which we'll see in just a moment. If we go ahead and throw on the anchored view apps on the QQQ weekly, we're above the entire cluster. This one will slowly provide confluence at this same level. No issues with the QQQ weekly trend if there's a pullback, right? This is the highest high in the trend count. It's so far looking like a successful breakout. If the weekly chart looks like this, I would certainly consider that a higher low opportunity over what's the number? Something like 516. Let's quickly check in on the volume profile, once again, to be completely congruent with what we've done over in the S&P 500. We'll drop this to a 6-month chart. And what we can see over here, there's sort of a volume shelf, not really much of anything to pay attention to. This as well would also offer a weekly higher low. The last higher low is probably this area, as the daily chart was in much more of a balance. Remember that this was not much of a daily downtrend either. So honestly, this high volume little protrusion right there, if that were to act as the higher low on the weekly, I would still be bullish as well. All right, daily time frame chart. Let's start to get granular here on the QQQ NASDAQ, see exactly what's going on. First things first, weekly expected move. What do we see out of the gray shaded box? Here it is. Upper bound is at 540.26, implying a new all-time high and a higher high in the trend count. And here is the lower bound at 520.86, in my opinion, offering a higher low to keep the daily trend in the upward direction. The current trend count is sort of as follows. We have lows, higher lows, higher lows. There's a very mild hourly downtrend in here, very mild hourly downtrend in here into that Tuesday session. And of course, we're at the highest high in the trend count. Now, one thing that we should pay close attention to here is the structure of the daily bar on Friday in the NASDAQ. We went on to produce a brand new all-time high, but where did we close? Right back at the high from the Wednesday session. So did we really accept these new all-time high prices? Hard to say that, especially with the S&P 500 moving in the downward direction as we just saw and potentially setting up a possible hourly lower high. So on the QQQ, I'd really have to pay most close attention to the low of Friday and also this previous pivot high here, which is at 526.50. On the daily time frame chart, I mean, just beautiful all-time high consolidation looking for continuation if we're over that level. If we start to come down underneath a little bit, I'd still be okay with a higher low happening here, but what's the big time threat, right? You could start to see how the big time threat becomes this: left, head, right shoulder. We don't want to be too speculative, right? The idea here is not to call the pattern before it actually happens, but it's a risk that you need to be aware of. If that starts to act as a lower high, now all of a sudden you have a daily reversal pattern. On the weekly, as we just called out, there's really no reason to be bearish if we're over this previous pivot high. So the weekly traders, if you're still going to maintain that bullish stance, would probably say something along the lines of like, okay, a gap fill reversal down here with a higher low back over that gap level, or even just a higher low back over 521.85, this multi-day consolidation low from in here. So the full pattern might look something like this. This might be where daily traders look at the weekly chart and say, okay, weekly higher low, daily's getting back into an uptrend. That's where I want to participate for the move back into blue sky territory. So if you're a believer of the pullback, that's a situation to watch out for. And again, we could probably have made the excuse in here that that sort of lower high is what kicks off that move. For the most part, though, until proven otherwise, I want to end on this note on the daily because I think it's the most important. Until proven otherwise, this is bullish consolidation, right? Until proven otherwise, if you're over 526.50 on the daily, there's absolutely nothing bearish to say about this chart, right? A little bit indecisive here, but nothing bearish. Let's take it on down to the hourly time frame chart. Let's evaluate what's going on from this perspective. So one note here is that the NASDAQ actually opened on a much stronger gap than the S&P 500 on Friday. So if I'm putting my bullish hat on, then ideally it would have been gap fill reversal to the penny, not testing inside of that range, and then we would have gotten some sort of higher low back over the open for continuation into blue sky territories. As we saw on the daily chart, it's an indecisive close. So is it really bullish, rock and roll, everything's firing on all cylinders? Not quite. But on the same token, right, as we were just ending the daily chart on, well, okay, if you use that same logic, if you're saying, okay, if stronger buyers would have stepped up here and that didn't happen, then in theory we have stronger sellers, right? Well, not quite either, because stronger sellers would have done what? They would have at least closed price action inside of the prior day's range, and that didn't really happen either. So it's indecisive at this moment in the NASDAQ. On the hourly chart, I would just have to lean into the idea that, of course, this is an uptrend happening here. We have lows, higher lows, higher lows, higher lows. We have highs, higher highs, higher highs, higher highs, brand new higher highs. So there's really no reason to be aggressively bearish, as we've already mentioned, but you might be a little bit more cautious of the move up here towards these highs. Where would we change our tone to being a little bit more bearish? Of course, this one's obvious. On the hourly chart, it would just have to be some sort of lower high here to rotate back down into 521.85, these lows that we were just talking about. Right? And then beyond that, of course, it's more about the gap close, but one step at a time that's outside of this week's expected move. Now, would I put a bunch of weight into this week's expected move and say it's impossible that the market comes underneath that? Absolutely not, because we know the Fed has their announcement this week on Wednesday. We'll be covering that live here on the channel, so if you're interested in seeing the Fed commentary, or at least what the market does from a technical perspective, tune into the channel at roughly 1:45, 1:50 Eastern time on Wednesday, the 18th, this upcoming week. We'll take a look at what the NASDAQ does, the S&P, interest rates, bonds, the whole 9 yards. So that's the analysis here so far on the QQQ. Let's drop this with a anchored VWAP study real quick. You can see great confluence there. I think that that's really got to be an easy line in the sand early on in the week. If we're above, bullish, no change. If we're underneath, starting to look for some more neutralization. And once again, if there is going to be some sort of major topping formation, maybe this is how it starts to unfold. Again, don't want to get too prescriptive or speculative just yet, but be mindful that under 526.50, that's where it starts to act as a threat for a potential lower high. So bears, this is for you. But the reality of the situation right now is that this probably seeks continuation in the upward direction until proven otherwise at this key level. All right, so I think we've covered this one until we're blue in the face about that 526.50. Let's jump on over to the NASDAQ side of the market internals, see if there's any divergence happening over here. Looks like the answer is not so much. You had a little bit stronger of a day on Wednesday relative to the S&P internals, but still in general, notice that we had net flows on the week out, negative 400 million. The substantial mark here is 600 million on the NASDAQ side. We still have a trending lower advanced decline line here, negative, trending lower on Wednesday, even though that was the day where the market broke out. Thursday is lower, Friday is lower as well. Actually getting into trend lower zone, the S&P did not get into trend lower zone out of the advanced decline line. Notice that your cumulative tick is bearish across all of the days, and the biggest bearish read was negative 7,800, and the substantial read here is 6,000 on the NASDAQ, 600 million and 6,000 on the tick. And we almost got there on Friday as well. So generally speaking, what I'm seeing is the breadth contraction across the market. It's really just a handful of names that are continuing to prop things up. If you were to look at a proxy of the NASDAQ, it's really AVGO Broadcom that caused a majority of the move higher. We know Broadcom reported earnings on Thursday night, AVGO real quick, just to illustrate the big move higher, right? This is responsible for keeping your NASDAQ higher and printing that all-time high on Friday. But if you look at something like Nvidia, obviously it was not participating. If you just look at something like the SMH, and we'll continue through all of these indications as well, semiconductors, the ETF in general, I mean, it was higher, but it pulled in a little bit more aggressively than that AVGO. Is this breaking to new record highs? The answer is no. Right? If you want something a little bit more even-keeled, you could use the SOX, which is weighted a little bit more evenly between the NASDAQ, what am I saying? Nvidia and all of the other top contenders in the index. You could go SOXX here for the actual ETF from iShares. Here it is on the daily, right? Notice how you have overhead supply. You're underneath that. There's the possibility for a rejection there. So it's not to be aggressively bearish, but it is to start pointing out some of the risks of this diminished breadth as the market rallies. And we'll talk about the Nvidia reversal pattern as well here in a couple of moments. To finish up the NASDAQ, though, we do need to take a look at the market profile on the NQ. And what I would like to highlight from this perspective is just the subtle difference from the ES, of course, the S&P 500, where your value is not breaking down, right? You obviously have value here, here, here. This is the Wednesday session. Thursday and Friday is overlapping to up. Notice that the point of control is even higher than what we had on the Wednesday session as well. So as mentioned, the NASDAQ's the place to continue to look out for longs. The S&P is where we're starting to see this weakness, right? Let's jump back on over to the platform here. Let's reset this. We'll go and take a look at the IWM small caps. We'll see what's going on from this point of view on a weekly time frame chart. And the small caps, not the place to be. Small caps are, of course, going to be more sensitive to that economic news. We got the CPI report last week, the PPI report, and even the jobless claims report on Thursday. The market did not respond favorably to any of that here in the IWM. So concerns about how the Fed reacts this week are probably elevated here. Now, from a weekly perspective, if we're sticking to our classic themes, what's the candle structure and location tell us? We, of course, have a solid red-bodied bar, much more bearish than what we've seen on the S&P, with the expansion of range here, noting that on the bar-to-bar count, of course, we've made a lower low and we have a lower high as well. The only saving grace for the IWM is the simple fact that we did not close back down underneath this breakout point. So if the IWM is going to produce a meaningful weekly higher low, it needs to stay above 227. 227 is the daily level that we've been using for a while. It'll now start to act as weekly. Up here, we actually had 236, and that did not hold. We broke down underneath that. If we come in with a couple of Fibonacci's, the most relevant ones coming from this August 5th low to the most recent high, which was a brand new all-time high, FYI, 38.2 is still stacked here. So it's not the end of the world in small caps, but my goodness, it is starting to put some pressure and act as a headwind for the S&P 500, which once again supports the thesis here, our general hypothesis that if you're looking for shorts, the S&P 500 is a place to be. If you're looking for longs, the NASDAQ is probably where you want to be, right? So that's what we have here. Let's come in with the anchored VWAP set on the weekly. This is not quite confluence, but slowly over the next couple of weeks, it might meet us there. And we're underneath the election breakout anchored VWAP. So again, a big change in tone here out of small caps relative to the other broad market ETFs and indexes that we track. Let's drop this down. We could take a look at the volume profile as well. Why not? One thing to remind yourself of here is that the previous all-time high in the balance range through 2021 really set up this quite meaningful high volume node. We're above that, and that would be your key area of support. Thankfully, or I shouldn't even say thankfully, it's just the way that, it's the nature of markets really. It is the top end of the retest area in here at 226 as we were just describing. Back down to the daily time frame chart, IWM, what else can we learn about the marketplace here for small caps? No appetite for smalls. I mean, just breaking down aggressively. We saw the weekly bar clearly looked different, but look at the breakdown from the overhead balance, right? Instead of just balancing out and going sideways, which would be more supportive of a healthy S&P 500, potentially threatening a break to blue sky territories, we've actually broken down more aggressively. And what I find most notable about this is what goes straight down can come straight up, probably comes straight down, meaning that we should have at least some sort of test of the daily 50 SMA in here, some sort of test of the inverted head and shoulders on the hourly that broke out 230. And that does keep us over the 227 weekly line in the sand, which is the only saving grace on this chart. From there, I think that there becomes a big battle up around this. Right here, we know it's a 50-cent zone. We've been talking about it all week, up around 239.80 down to 239.30. If you get a rally off of this, I think you fall into some sort of range compression out of the IWM, and it's almost like deja vu, right? What did we have back here? Same concept, flat highs, but some sort of compression on the lows. I think you get something similar out of this here until ultimately we get more clarity as to what's going on with inflation, which we'll talk more about in just a few moments. So generally speaking, it's not bearish on the highest time frame charts. You still have that opportunity for the weekly higher low here, but in the short term, definitely still a pain point for the S&P 500, and primarily that's why we use the IWM. How can it help us, or sort of keep us on the right side, I should say, of the S&P 500? Much more meaningful breakdowns underneath key levels, obviously on the hourly time frame chart, setting lower highs underneath the balance range. That was the nail in the coffin on Wednesday. Thursday breaking down, Friday getting continuation. What we didn't talk about on the daily chart was the weekly expected move. The lower bound is sort of stacked in here at 227.57, so it's right on the money with the weekly line in the sand, and the upper bound is right on the money with the bottom end of the overhead supply. So once again, this range compression seems very reasonable to me at this point in time until we have further clarity from the Fed So expect on Wednesday maybe some more fireworks here specifically in the IWM. That's really what we're seeing. We could take a look at the intraday anchored view apps. They're not really going to tell us much other than, again, bears have much more of an edge in small caps than in the S&P as well as the NASDAQ. What do we see in terms of the exchange level participation in the Russell, which is really index level participation? Much more of a mild earlier start to the week, but getting those volume outflows on Thursday and Friday. Same thing happening here in the advanced decline line and the cumulative tick as well. It's not really like there was much hiding, even with some of these more mild. Again, it's not like we had bullish reads on Monday, Tuesday, Wednesday, but notice how this really wasn't all that bad. Cumulative ticks were technically positive in here. Advanced decline line was positive. What was the actual index doing? It really wasn't making much progress. So even on the slightly more mild internals earlier in the week, you were still getting weakness out of the Rusty Russell, which once again is sort of an indication to say, hey, maybe a bit more of a headwind for the S&P 500 as we come into, I should say, this traditionally bullish time of the year. I mean, just not really adding up in my view as of right now with everything firing on all cylinders. Let's take a look at the Rusty Russell market profile, see what else we can learn here. It's going to be pretty straightforward. That value, of course, is moving lower with price. Here was Monday, value area and point of control slammed lower in the profile. Then you can see here on Tuesday, Wednesday, a little bit of balance, a little bit of consolidation. If anything, on the daily chart, it was actually just a bear flag underneath the bottom of the range that we were just talking about. Here's the follow through. Value is lower, as is point of control, as is point of control. A period, just complete rejections of the previous day's range. So really not seeing any response from the buyers out of the Russell at this point. It's going to require a change in tone, probably fundamentally from Jerome Powell on Wednesday, if the Rusty Russell is going to catch a bid. Ever since Wednesday, which was the CPI report, which came in, yes, at the market's expectations, but still elevated relative to the Fed's target, it's just been, down the drain for small caps here. So with that, we'll jump back on over to the platform and we will continue along with the S&P supporting evidence, starting with none other than the weekly performance of the S&P sectors. Leading the pack here is not actually an S&P sector, rather an industry from the technology sector, the SMH Semiconductors, up 1.33% on the week. So technically speaking, as the market's just going sideways up here, you are seeing risk on support from a pretty meaningful and risk-on sector. Underneath is the XLY, consumer discretionary, up 0.58%. And then you can see XLC is the third and the last green sector of the week, up 10 basis points out of communications. At the bottom of the barrel, it's the TLT, which is, of course, absolutely getting obliterated with 10-year rates ripping in the upward direction. Not directly an S&P sector, so let's move along to the next three. We have materials, the lightest weight sector. It's not necessarily risk-on or risk-off. Energy, another lightweight sector here, maybe a little bit more related to inflation. And then we also have the XLU, a D for defensive sector. So even though we've talked about technical formations and maybe bad breath and seeing that reflected in the market internals, the posture of the market as we're just going sideways up here isn't really all that indicative of a risk-off rotation, which makes this a little tricky. And if I'm thinking back through everything we've mentioned so far, I don't want to say it was a stretch to make some of these bearish assumptions about what might happen in the future. Those things are certainly risks. But as of right now, if we just go back to like face value of the S&P 500, it's in a balance range. And as I've mentioned, it's still bullish over $600.50. So I would not prematurely jump the gun and say, oh my goodness, the market's going to crash and go to zero. I think some of these threats are things that we should start thinking about and talking about. But again, at face value, nothing is inherently bearish yet, I will say, okay? So anyways, let's jump into the performance of the actual charts. Semiconductors, this chart just can't get in gear. I mean, a little bit of that gap up with the love from AVGO on the Friday session and, maybe back inside of what I'm just going to now dub as the balance range here. So where did we close? Literally in the midpoint of that range. What do we know about balance ranges? Don't exchange in the range, don't enter in the center, do not diddle in the middle of a balance range. We're tangled up at a pretty much flattened out daily 50 SMA. The 200 SMA is still upward sloping, and I will give credit where credit is due. It is still supporting price once, twice. Now, you might say, okay, that's got to be bullish. We're supporting the daily 200 SMA. This is, Matt, pay attention, dude. This is a higher low. Great. If you're going to call out higher lows, you may as well call out lower highs as well. Don't play one-sided, play both sides. And as of right now, this is a balance range. We do not have a strong trend, and this is where I think that some of that risk steps in for the S&P 500. If we continue along to the XLY, what do we see over here? Chart looks phenomenal. As we've mentioned for a number of weeks now in a row, straight up continuation or pullback finds a higher low. There's no issues with that. Now, what's the issue, right? I just said there were none, but what is technically a possibility here? Well, if the XLY pulls back, right, what does that mean intra-week for the S&P 500? Probably some sort of pullback there as well, right? So pay very close attention to these things. It doesn't mean that the trend overall is going to change on the higher time frames, but intra-week, if you see like Tesla and Amazon down, you're probably dealing with an XLY that's pulling back. If we move along to the communications sector, it's very similar. You did start to print a little bit more of that pullback already, mainly coming from some weakness out of Google into the end of the week here. But where are we? I mean, we're still well above, lots of areas where higher lows could be found. Ideally, it would be this, previous resistance acts as support, but I wouldn't really throw in the towel on the long side as long as we're over 97.65. I mean, this finds a weekly higher low. This has been a massive breakout to new record highs. I mean, let these charts develop and digest. Now, once again, what does this mean in the short term for the S&P 500 if the pullback continues? If we're under $100, then yeah, maybe you get a little bit of volatility to the downside in the SPY index, the ETF, I should say, itself. Here's the TLT, which just absolutely collapsed into the end of the week post CPI report. PPI, the producer price index, actually came in much hotter than the expectation. Hotter, geez, what type of accent was that? But it came in hotter than the expectation, and that, of course, might have implications as to what happens with the next CPI report, right? Producers basically just pass costs on to the consumer. So interest rates aggressively moving higher, bonds falling off of a cliff here back down towards this equal low. Now, one trade that I'm rinsing and repeating from earlier on, we did this earlier in, I think it was late October, early November. We sold TLT puts. So just as a, do so at your own peril. Of course, you have to figure out trades that work for your own risk reward, but I don't oftentimes swing trade things or it's not really the MO of what I do, but I figured, if I am doing something on a longer time scale that's maybe more relevant to my thoughts about the market, then I may as well tell you here. I'm still short TLT puts, or actually what I should say is I sold another round of TLT puts around the 85, 84 strike going out to February. From a technical perspective, of course, this is just kind of the bottom end of the history of the TLT, but just generally as well, if you're a believer that the Fed's going to cut rates, if you're a believer that in theory progress on inflation is substantial and the Fed is more interested in saving the labor market, then, I would tend to think that there's at least some sort of bottom that happens over here. You can see after the collapse through 2022, there's a change in tone, right? You had lows, lower lows. You finally started to produce a higher low. You had an equal high in here. So I do believe, and again, with my own positioning here, I am sort of short TLT puts at the 85 mark. I would love to own TLT there. I'll take the yield, and that's fine. I do believe that this is an opportunity to get back up towards the top of the range here, a little bit overblown in the short term. We'll see. I could be totally wrong about that, but that is my belief on the TLT for now. A little bit long-winded there. Let's get back on over to what we do best, which is just the technical breakdown of the charts. The XLB materials sector, one of the worst performers this week, falling off of a cliff, but into what? Just a big balance range in here. Even if it sets lower highs, that's fine. I think it's notable that we've broken the daily 200 SMA. I think it's notable that we've made a new pivot low, but we haven't really broken down from a big chunk of value where a majority of 2024, the entire calendar year, was spent. So I think these prices are familiar for most folks, not really a big deal there. It might have better implications, just generally speaking, about what's going on with the cyclical side of the economy, right? With materials, building, quite literally. You could look at something like the XHB real quick, just to get a sense for that cyclical side. Building, and so, this is literally home builders. What I find most compelling is that obviously this is just moving in response to interest rates. So if Jerome Powell really wants to stimulate the economy and he's going to slam rates lower, if he says, instead of 25 basis points of rate cuts, I'm going to go 50 basis points, this is probably going to pop right back in the upward direction. So generally, that's not what I believe he should do. I think that would be a little bit irresponsible to do a 50 basis point cut. We'll talk more about that in a moment, but this is still well within range of where prices are familiar. Energy, what's going on over here? Rotating firmly into this balance range, midpoint of that balance range. It's been a pretty substantial drop-off from the top end. If we look at crude is positioned sort of towards the top end of its range. So I do believe that energy, if this breaks out, for example, to the upside, you're probably dealing with higher interest rates, but energy will probably move in the upward direction. Just generally, if you think about what that means for the global economy, there's a lot of talk about demand for oil being pretty low. We had the OPEC meetings last week. It's a air quotes global recession minus the U.S. basically at this point is what I'm seeing based on everything. I mean, the simplest form. Look at the XLY. This is consumer discretionary, so non-necessary spend basically for the U.S. consumer, ripping to new all-time highs. So what recession? I'm not seeing it either. GDP revisions back up to 3.3%. Incredible. XLU, what's going on with utilities, the most bond-like and defensive sector? It's breaking down, sort of mirroring what was going on with that TLT almost. Not quite as aggressive into the end of the week, but if it starts to take this out, I would certainly be open-minded for downward pressure in the S&P, but is it going to sink the ship? The answer is no. Next up, XLV. This one can sink the ship. This is the fourth heaviest weight sector by market cap. What do we see over here? 100% retracement of this move back down into the equal low. And what do we see? Actually, a little bit of a change in tone here. Instead of a solid red-bodied bar, a little bit more of an indecisive doji at the equal low. I wouldn't be shocked, and this is typical of 100% retracements, to see some sort of counter trend move. If it is going to break, you'll see a lower high and equal low, and then we'll take it out. If it just consolidates sideways, that's basically the equivalent of consolidation via time, not via price, and setting some sort of lower high. I would flip back to being bullish on this if it wants to recapture is 144.35, and that's really where I would say that the S&P 500 captures more of a rotational market and not so much just an outright sell-off. One of the concepts to keep in the back of your mind here is if not all of the sectors are blood red, the S&P 500 is going to stay afloat, right? The S&P has much more of a propensity to rotate than the NASDAQ itself. So from that perspective, which I know is contradictory to what we talked about on the long NASDAQ, short S&P, but if the sectors are rotating, if you're seeing love in XLY, and then let's say that the love this upcoming week goes into healthcare, and then next week it's the financial sector, if you're seeing that rotation, your S&P 500 is not going to be down aggressively, and you should basically look for mild pullbacks to get bought up or just sideways consolidation. And then when everything starts acting in unison back in the upward direction, that's where your all-time high breakout comes in, right? So anyways, XLV 140.80 and 144.35 key levels this week. If we're underneath 140.80, probably a bit more of a headwind for the market. Let's move into the real estate sector. The same thing as the XHB we were just looking at. Basically, no big concerns here. Industrials starting to close that gap a little bit more from the election. This has the opportunity for a weekly higher low, obviously in the short term, bearish for the S&P, as long as it's underneath the daily 50 SMA and 139.15. It's not a really heavyweight sector, it's more so mid-tier. XLF is the second heaviest weight sector by market cap, neck and neck with the XLY. Notice left, head, right. This has been a story for the past couple of weeks in the market. This move really fueled the S&P to new all-time highs, and then the baton was passed, if you will, over to the XLK. If this breaks down, I would tend to think that you have an opportunity to at least see some continued headwinds in the S&P into 48.70, at which point in time the daily 50 SMA will meet us there for super support. If that catches and finds itself a weekly higher low, I think the rotation concept we were just talking about keeps the S&P afloat. If we do not hold up there and move through the election gap, that's where your seasonality does not come to bear any fruits, and the S&P 500 disappoints everybody to end out the year. So financials are a top watch into the end of the year based on the rotation and based on the relationship with the XLK, which we'll talk about in one more sector. Here's the XLP, nothing to talk about here, midpoint of the range. So let's just cut to the chase. Here is the XLK, brand new record highs earlier on, this is the end of last week, my apologies, and just sort of consolidating over the previous all-time high. So is it bearish, just like the QQQ? Outright right now? Not really, but slowing down a little bit. It's not continuing to progress into blue sky territory. Obviously, your consolidation here keeps the bulls on parade. Blue sky breakouts on a Brigade bolt over 242. Where does the concerns step in? Well, if the XLK comes under 234, fails the daily 50 SMA, and here's the key, right? And the XLF is closing the election gap or breaking down underneath its head and shoulders neckline. That's where you get your S&P 500. That's like, okay, look out below. It's not going to end well. What's going to cause the XLK to do this? Well, none other than Nvidia. If it breaks down underneath its key weekly at this point, balance lows, right? You could start to make the argument. I know we're getting a little bit ahead of ourselves, but right, maybe there's a Man Ray pattern in here. Left head, double head, if you will. Right shoulder, equal lows right across the neckline. If this breaks down, look at the bar from Friday, underneath the daily 50 SMA, rejecting, right? Obviously from here to here, a lower high. Let's be honest about the chart, right? These are equal lows. If you take that out, and I'm not ignorant to the fact, of course, that if you look left, right, prior resistance, support once, twice, 3 times, 4 times, I get it. It's a reasonable area to take a stab for this kind of idea here, but the pattern itself, the change in tone, the change in trend, let's also just play, fundamental analyst here for a moment. What happened with earnings? Growth rate slowed down. People did not like that. What happened over here? China probe. Just more bad news about Nvidia. I get this sour taste in my mouth. Let's book some profits on this. It's up 1,200% from the lows in 2022. even if you just get a profit-taking sell-off underneath this level, I think it makes sense from a technical perspective here. Anyways, not to drive the point home too much on Nvidia prematurely, but that's what I'm seeing here as the major threats to the market as we go through this weekend update. Let's take a look at the S&P ratios. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Still looks risk on, still looks risk on. This still looks okay. I'd put a neutral tilde there. This is fine. Remember that the XLV is D for defensive. It's heavyweight, but it's D for defensive. This looks okay. That's more bullish than it is bearish. This is kind of neutral. This is a non-issue, and this is a non-issue over here. So it's still risk on, as we've talked about from a posture perspective through the S&P sectors. I'm not trying to make a premature bearish call, but I'm just pointing out where these changes in tone will happen if there's going to be a disappointing end of the year. And I really do believe it's going to be driven by Nvidia sinking the ship and semiconductors sort of being an underperformer into the end of the year if financials can't pick up the slack, basically. Anyways, what else is going on here with the specialized ratios? Let's take a look. Risk on versus risk off still looks risk on, still looks risk on, still looks risk on, still looks risk on with the breakout here into the end of the week out of semiconductors versus healthcare. I'm just realizing now that these are not attached to the window, but rather to the background of the chart itself. So we'll have to update those, but you guys get the gist of what's going on here. Generally speaking, the Chinese market's still catching some trouble even after the stimulus announcement here. So when you're thinking about the GR, the global recession that we were talking more so about when we were dealing with energy, China not looking so hot. Stimulus, as we pointed out over on X, right? Let's jump on over to some other indications here. The dollar will start to get a little bit more fundamental. So as rates move in the upward direction, as is the dollar, typically that's going to reduce the future expectation of earnings here on the S&P, which kind of stacks up as a bearish data point. Notice that this is a long-standing balance that we've recaptured the top end of. Long standing balance back here, and now we're using that as support. Something interesting that was brought up over, I can't remember exactly where it came from, social media somewhere, but when we had the first time in office from the president-elect, we saw a pretty strong dollar over here. So we're, sort of not forecasting that it needs to be a strong dollar. I'm not from a technical perspective calling for 114, but if we're going to get, tariffs, if we're going to get these sort of concepts that are being talked about, wouldn't be shocking to see this remain higher and sort of see continuation to the upside out of the dollar. Let's see what's going on with gold and what's happening from the yellow metal perspective. Lower high on the ratio relative to the S&P 500. So flight to safety and hard assets, not really. Gold also underperforming here. So once again, not totally bearish. I think that the fundamental narrative gets a little bit fuzzy here, and we'll get some clarity on Wednesday. If we look at interest rates absolutely breaking out, though, again, or attempting the breakout again in the upward direction, you could say that this is staying over the retest. You could also say from a weekly perspective, right? If I do something like this, we're back over this resistance trend line right here. We had broken out before, and we all know that 4.3 is such a critical point in the 10-year interest rate. We were underneath it for a while. It was like, okay, things are coming back down to earth. Maybe inflation is under control. Remember that Jerome Powell basically cut rates, and the market said, whoa, what are you doing? And it ripped right in the face of those rate cuts. We're almost about to get the same exact thing here where it was like, okay, maybe the market's coming back in sync. Maybe that inflation issue is not as big of a deal. But on the heels of this latest CPI report, certainly back over 4.3, re-triggering the breakout of the resistance trendline here does lead to some concerns about the possible inflation progress that's been made and whether or not this 3% floor on the core and the 2.5% floor on the non-core CPI is really going to stick. If we take a look at the inverted ZT to get a sense for what's going to happen with rates, a little bit of an uptick here is somewhat surprising considering that the odds of a rate cut dramatically increased after the CPI report. So let's just go take a look at that now. If we jump on over to here and we look at this. So before the CPI report came out, we actually had higher odds of a pause. Now, I mean, not higher in terms of net between the pause versus cut, but higher relative to where we are today, of course. After CPI came out, the market said, no way, to heck with any sort of pause. We're absolutely expecting a 25 basis point cut. And in my opinion, this really comes from the idea that Jerome Powell is likely going to be more concerned about saving face and not seeing the labor market blow up. You can see that we absolutely missed big time. The initial jobless claims here and continuing jobless claims actually saw an uptick as well. Now, we know that the full labor report actually came out 2 weeks ago now. And I do want to bring this up now that Thinkorswim has synced the data. Thinkorswim has sunk the data? Synced the data. Think or swim. What are you doing? Sinking or swimming? Anyways, uptick out of the unemployment rate, which we were expecting, right? That was not a big shock over here to 4.2. But the SOM rule remains uninverted, underneath this 0.5. So in theory, this uninversion of the SOM rule should say that we avoid a recession here. However, if this continues in the upward direction, now we start to deal with that R word, right? Recessions, 90% of the recessionary cases that we've seen over the last modern times, at least we will say, are due to the labor force deteriorating, right? Or I should say mass unemployment. So Jerome Powell, in my opinion, probably wants to get ahead of this and isn't so concerned about the inflation front. So if we just go back over here, we did see the CPI come in at the expectations, but hot. A 0.3 annualized is not something we can deal with. Same thing here with the non-core. And then the year over year, we talked more about this on Wednesday, the same day of the report. But generally speaking, right, this is an uptick over the prior. And I actually think that the next forecast, so December inflation based on swaps already being priced in, is coming in at a 2.9%. 2.9%. So I'm really curious to see what Jerome Powell has to say here during his press conference on the Wednesday session. We will get a new SEP, so we'll see what the projections are from the entire committee. But my expectation here is that they're going to come out, they're going to issue the 25 basis point rate cut to save face on the labor market, but you better believe Jerome Powell is going to be the hawkish person you've ever heard. He has to talk down the markets if he's going to issue a 25 basis point rate cut, in my opinion. And once again, we will be live here on the channel to cover that as it's unfolding. Tune in Wednesday. We'll kick off the stream at something like 1:50, 1:45, and we'll see what happens into the afternoon there. We will get final GDP, jobless claims on Thursday per usual, and earlier on in the week as well, you might want to pay attention to retail sales here to see whether or not we're getting some early signs that consumers are dialing back with their spend. And once again, if that starts to happen, you sort of fall into this negative cycle with job growth, and the labor market becomes much more of an issue. As of right now, based on what I can see, I'm not overly concerned with labor yet. We'll put a yet on that. Okay, let's take a look at the earnings calendar for this week. Nice and festive from Earnings Whispers. So thank you guys for the red calendar here today. We've got ourselves General Mills from a value perspective, but most importantly, probably Micron, probably Nike from a consumer spend perspective, and FedEx always has awesome insights as to what's going on with the economy. Ultimately, they know whether or not shipping volumes are up, are people dialing back from the commercial perspective, retail, what's it all look like, right? So FedEx insights Thursday after the close will be pretty influential over what happens with the market, in my opinion. Remember that they sort of called the 2022 recession. So we'll give them the respect they deserve. Let's get back on over to the platform here. Let's finish up the interpretation of the data points. We have the TLT ratio to the S&P, of course, with the collapse in the TLT and rates moving higher. No surprise to see this lower. So you're not currently seeing a flight to safety. I would expect this to cool off, though. We did just print a new lower low. So what does it mean? You're not going to get any issues from that flight to safety perspective for at least another couple of weeks as a cycle. Here are bonds relative to themselves as rates move in the upward direction. Not a shock here to see these things catch themselves for higher lows. Once again, they're kind of unchanged from these prior levels, so I think that the inflation story is not fully resolved, which makes sense with what we've talked about so far on CPI. I really think Jerome Powell has the power to sink or swim for the market, right? So that is what we're looking forward to on Wednesday with his commentary, either hawkish or dovish. If he goes double dove, if he goes with a 25 basis point rate cut and talks dovishly, market's going to go on to produce brand new all-time highs. That's my opinion here. Less data-driven, but just opinionated on what could happen on Wednesday. Here is the junk bond, not the junk bond spread, but we want the junk bond spread here. These are credit spreads. There we are. This is a proxy for volatility in the market. They're definitely in longer-term downtrends, but you are seeing subtle upticks here into the end of last week. And generally, that's why, a little bit more of a reason to believe, okay, stay on the edge of your seat as the market balances out a little bit instead of just continuing in the upward direction. As we take a look at here we go. Now we'll get into the junk bonds just in isolation. HYG, this is still divergent, generally speaking. If you take a look at where this low is to where we are currently, right, that's something like from here to this higher low. So junk bonds are still calling the bluff of the market. Once again, a slightly more bearish data point. I hope you can see I didn't want to be bearish just for the sake of being bearish on a daily balance in the S&P 500. There are some underpinning things that start to suggest, okay, buckle up. If it's going to happen, the warning signs are starting to reveal themselves, right? Let's take a look at Bitcoin just as a risk on or risk off proxy, still well up here in its consolidation from the big breakout to the 100K handle. Not really an issue out of Bitcoin. This definitely falls into the risk on category. Let's take a look at total breadth, which as we've described in multiple episodes now, is contracting, still continues to be the case. The 50 SMA, that's the blue line here, stocks in the S&P 500 over the 50 SMA is underneath the 50% mark. You can see new highs versus lows has actually flipped negative. So the breadth component is there. It's just a matter of the last domino falling. In my opinion, it's that one stock to rule them all. If it breaks down, I think things get a little ugly here for the S&P 500 and seasonality disappoints. Don't want to be overly bearish, but once again, the warning signs are starting to emerge. Just want to call it as we see it. Let's take a look at, let's jump on over here to the RSP. This is the equal weight S&P 500 index. We've talked about this over on X. Big breakdown here, still holding up in the weighted index. Again, what does this suggest? It's a couple of the magnificent 7 names, the heavyweight names in the S&P. Think about your Apple breaking to new record highs, Amazon, Tesla, right? Those names are propping up the S&P. Any pullback in those names likely means that you start to see a little bit more of a pullback in the S&P index itself, with the other underpinnings, basically all other 493 other stocks already moving in the downward direction a little bit more aggressively. Let's see the same thing over in the QQQE. If I just zoom in on this over here, NASDAQ, as we know, making a new record high and seeing a lower high out of the weighted up above. You could talk to folks about the Dow, and it's the same thing. Dow has been driving, driving in the downward direction, thought of as like the value side of the market relative to the S&P, which is tech dominated now. Of course, NASDAQ tech dominated. It's not small caps. So seeing a similar indication over here. One compelling argument is just that if you do something like this, if you do something like this, we're just approaching the bottom end of the trend channel. You could make the same argument over here in the RSP. If I just zoom this out to, I don't know, let's go to a daily, right? You could make the same exact argument. Hey, this is a multi-touch trendline buying opportunity, perhaps. Maybe we'll see value start to outperform a little bit. It's an idea. It's an idea, and that rotation would certainly keep the S&P more so sideways than anything else. But as of right now, I think we're starting to use these data points more so as potential changes in tone than potential trade ideas, really. It's a change in tone for the marketplace overall. VIX volatility, what do we see going on over here? Still depressed underneath 15. If we take a look at the VVIX, still underneath 103. Thought so. I had to second guess on Friday's move. I didn't check in Friday after the close, actually, but still underneath 103, so the opportunity for a lower high still lives on. And if we take a look at the volatility spread through this perspective, contango, which is bullish for the market, 9 versus 30, still bullish for the market. One-day VIX is still trading near record lows for the brand new read of volatility, basically. Remember that this is the first print from way back over here. What else can we show you? The skew is elevated, so it's not just me who's saying, okay, the warning signs are starting to show us something. People are actually taking positions. Out of the money put volatility is moving in the upward direction. Those prices paid are moving in the upward direction. People are buying insurance. This is folks betting on a black swan. Now, I'm not going to go out and get to the point of saying, okay, we're going to short the market into the ground because of the skew elevating, but just generally speaking about the sentiment of participants in the market right now, we're not the only ones picking up on some of the air quotes issues of what's going on here. One of the non-issues, though, I would just remind you of as a general time period is, if you remember, when we were coming out of the 2022 base, early 2023, this is when AI was really starting to come on the scene, and Nvidia was starting to become the one stock to rule them all. We'll just say N for Nvidia. When that was taking place, breadth was actually horrific. Everybody was talking about, the concentration risk in Nvidia, myself included, right? We were at least calling it out as something to pay attention to. So could it be another one of those instances? It's possible. What's the difference between the two timeframes, though? Right? This is coming out of a bottom where everything's oversold, air quotes, from a market perspective. This is where everything's frothy. This is where everything could be take profit, right? You're seeing take profit elsewhere. If these start to fall, I think that concentration risk means much more when you're at the highs versus coming out of a base, right? Not to try to call a top. Again, the point here is not to try to call a top, but rather recognize when there are changes in tone, and maybe we should start to respect that a little bit more so. We all know that the only way the S&P 500 more aggressively falls in the downward direction, and I do want to share this chart with you as well here today, is when the monthly trend flips to down. Here, let's zoom in on the dot-com crisis, right? Double top, lower high, lows, lower lows, painful moment, painful moment. Just to go through the exercise over and over again. We're not trying to call the top until the monthly trend actually flips to down. Downtrend, big painful watershed moment, right? So why am I showing you this chart? Well, every single time, maybe not every time, but most times the yield curve uninverts, right? Here we go, here we go, here we go. We're starting to do it now. This is the 10-2. We could look at the 10-3 month as well. Pain, pain, pain. Is it going to lead to pain here? There's a minor sense of this too for the sickness plunge, of course. It's if the change in tone happens across breadth, if we see a monthly downtrend develop, I mean, all of the historic signals are sort of there for, again, not an outright Armageddon crash. We're still in uptrends. I'm not trying to get ahead of this prematurely. Hopefully, I've been very, very clear about this, right? But the signs are worth paying attention to. Let's take a look at the Fed funds rate, right? Because once again, I've built this chart very intentionally. We haven't looked at these things in a very long time. When the Fed starts its cutting cycle, bad things happen, bad things happen, bad things happen, bad things happen. What do we see here in the more modern times? The dot-com era, great financial crisis, sickness, not saying it has to be a 50% drawdown. I'm just saying pay attention to the change in tone out of the S&P. Pay attention to if the one stock to rule them all starts to underperform, if interest rates are moving the opposite direction of the Fed funds rate, if the market's calling the bluff on inflation, just things to be thinking about. And I suppose this is maybe a good time to just sort of reflect on, this is a higher timescale thought process that's probably appropriate at the year end. What do we have in store for the upcoming year, right? So maybe this, I'm not going to say it's going to replace the 2025 outlook, but these are some of the themes that we'll start talking about when we get to it. So with that complete, let's take a look through the core list of companies. Then I have one trade idea for you. We've pretty much covered Nvidia and my thoughts on the risk here. Left, double head, right, Man ray pattern. Your key level of support has to be the 132.25. And then down here, it's a little bit of a zone, right? We've got 129.50, previous pivot high from back there. If we can stay above, can't throw the towel in on it yet. If we start to break down and accept below, that's where I think things get a little bit more risky, or maybe talking about more of a move towards the daily 200 SMA, one step at a time, not calling for this week, just pointing out what could happen. If we take it down to the hourly, this is where we start to get granular. So recall that this is the China probe, right? This is sort of the recovery. Beautiful gap fill reversal. So let's really rewind it to Tuesday. Gap fill reversal keeps the sellers in control. Thursday, I thought that this was going to be a stronger down day opening underneath this key level, 137.25. It didn't happen. So then on Friday, the open firmly with the AVGO sympathy gap up. That should have yielded what? I mean, if this was going to totally play back in the upward direction, this is what should have happened for the retracement. Did that take place? The answer is no. It still seems like Nvidia is not getting any love from any of the folks who really loved it through the whole AI rally in the upward direction. It's more so looking like, to me, booking profits and the potential for a big change in tone on the daily that we were just talking about. So short-term Nvidia have to be a little bit more of a bear than I am a bull, even on the medium term, if you will. To be bullish on this, I have to see this. I have to see over 140. I have to see recapture the daily 50 SMA. Of course, to get there, are there opportunities that exploit this? Sure. But generally speaking, I think you have too much of a bearish change in tone out of this. I've talked about this so much in today's episode. I think that's really the last domino to fall for the S&P if something more malicious is going to happen into the end of the year. Here we go with Microsoft, head and shoulders, maybe. Show me more acceptance in this range and I'll believe it, and then I'll start looking for shorts or a trend change underneath this 441.50. We're not there yet. I would be open-minded to this, really actually offering more of a bullish position back in the upward direction, exploiting risk-reward back up towards the earlier week highs. If that happens, great. 448 is our risk up towards the high. Let's pop a level in there together at 455. 455 will act as that upside target. Here we go. Got it. There we have it. Anything in the range, once again, a little bit more neutral, changing to bearish under 441.50. Next up, Apple. This is the old guard of tech. I think that rotation we were talking about in the market financials drove the S&P through the election move higher, and then it sort of flipped back to technology. Apple, don't forget, is still one of the top dogs in the XLK. And look at this massive breakout to brand new record highs. So the old guard of tech is still dominating here. If this pulls back in, fine. I mean, look at the opportunity for a weekly higher low, daily higher low. There was no hourly downtrend here. As long as you're over 236.50, it's very difficult to be bearish in Apple in any sort of grand sense. If you're looking at the smaller time frames, yeah, I mean, maybe left head, right shoulder, neckline break. Even at that, I would not be short into this retest at 244. I would actually look for longs off of that level back to the highs, looking at risk reward along these lines. If this comes in, I would be bearish and start to change my tone under 244, and then the breakdown is really this, right? Risk reward back down into the weekly level at 236.50 underneath 241.25, the bottom end of this multi-day range here. That's Apple. Next up, Amazon. Amazon starting to get a little bit slow and sluggish up here towards the top end of its new range that it's built out. Couldn't really get in gear on what would that have been the Thursday session near those all-time highs. Friday, more firmly in range. So we'll call it for what it is, maybe left head, right. That sort of starts to seem like a more common pattern out there. Once again, where do we get bearish? It's not just randomly in the range. If you take out the lows of the balance and you set a lower high underneath, yeah, I mean, this starts to become a little bit more reasonable. The gap close interaction is interesting. 215.75, 214. This is how we look for the downside, right? Next up, and of course, consolidation that does this obviously has to be bullish. So really, it's just balance rules in place. Forget about the head and shoulders even for just a moment. It's balance rules in play until anything else sort of develops, right? This or this. Anything in the midpoint, sideways, right? Next up, Google, the quantum computer. Willow, how are you? Lower high underneath. I thought there was going to be a more meaningful breakdown sooner in the session through this thin structure. It's still in play. This is sort of that short we were looking for earlier in the week when we were doing the Wednesday midweek market update. Some sort of like blow off top, lower high, and then a breakdown through these equal lows, off sides, if there was some sort of gap up. So I still think that buyers who are long from this location have poor location, and we look for that rotation to the downside. So continuing to monitor for that, I would change my tone if this inverts and then pulls off one of these, right? Then it's just daily bull flag. Still a little bit tough to, build the longer term thesis for a long up here at 195, but generally risk reward would have to favor blue sky breakouts if the trend remains up. Next up, Metaverse looks good inside of its range. I really don't think it's a big short per se. I think that it balances off in here. Yes, maybe look above and fail, targets the bottom. I don't think it's a short through the congestion. I think if anything, it's a retest higher low over 599. Zoom out, give yourself the perspective. Here it is on the daily. There's the balance range. Break, hold, Brigade bolt, right? 599, still thinking about longer term supports there. Tesla, just a monster, continuing to move to new record highs here. Can't say anything bearish about it until it's underneath 409.50, holding the previous all-time high way off to our left at 415 as support 2 days in a row, right? Thursday's low, Friday's low. I was honestly looking for a little undercut of that and then the move higher. Didn't happen. It just held right on to that, now what is now two perfect retests of that 415. So has to be bullish until proven otherwise. You probably have another minor level in here, not to get too level happy, but something like 425.15 will certainly persist as a minor watch as we move into blue sky territories. Anything that looks like this keeps the bulls in control for an hourly higher low. Next up, JP Morgan is just a watch for the financial sector. It's really been a slug to trade recently. Not that it wasn't back over here. It certainly was. But generally in this range, look above and fail, still leads me to believe that the XLF wants to come into the bottom end of the election move. And once again, we know that that probably acts as a headwind to the S&P 500, especially if tech pulls back. Finally, Netflix, and then I have one trade idea for you, as I've promised. What do we see over here? Resistance, support, indecisive doji. Nothing to say bearish about Netflix if it's inside of this range. Maybe look above and fail, but that's already completed to the bottom end of the range. So neutral persists in here. And again, not sponsored. Reach out, New Balance, if you'd like the sponsorship. But New Balance, right? This is a new balance range here. If we take out the top, 935 gets interesting. Higher low continuation probably goes on to seek the big 1,000 figure. If we drop this, again, just simple balance rules in force here. The major target would be down at 868, but please respect 882.50. One trade idea for you is on DocuSign. DOCU is the ticker on that, of course. If we just go out to a daily chart, pointing out that this has made a very strong run as many of the old market leaders from the sickness era have sort of made a comeback. But is it too far too fast on earnings? We're underneath the earnings opening print. We have two equal lows. We have back-to-back inverted hammers. If the market sees a pullback this week, DocuSign to me is one of those names that should sort of, fall off the radar. It's going to be a flight to safety. If tech catches a bid and the market's pulling back, you're probably looking at Microsoft, those safe haven names, right? Oh, these things aren't going to go to zero. DocuSign, on the other hand, underneath these two equal lows, could probably come in and close a little bit more of that earnings gap. We have 86.75, 84.40 is the full gap close, 93.40 is the 2-day low that we're looking for a potential breakdown under. You can see here just the lack of euphoria. Here it is, and it fades, right? Lower high underneath, looked above, lower high underneath, and now the equal low, once again, breakdown is interesting here if we need stronger shorts. Outside of that, I really hadn't seen many market setups that were actually interesting based on the current location of the charts headed into this week. Maybe that'll change as of the close on Monday. If you want continued trade ideas, check us out over on the X platform. We've been posting a ton of charts, hopefully piquing your interest and keeping tabs on the major setups that are driving this market. That's going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Once again, we will be live on Wednesday to cover the Fed, but we're live every morning at 8 o'clock Eastern Time for our pre-market prep session. Hope to see you there. It's here live on the channel, free and open to everybody. With that said, have a green trading week, and I will see you in the next one.